Sean Peche is the founder and chief investment officer of Ranmore. We're going to talk today about a big story that involves Sean himself and his company, which I think is going to make many people in the BizNews tribe very excited. It opens a whole new avenue of opportunity for two of our favorite money managers. And then we're going to also be having a look at some of the latest developments and how Sean manages to actually outperform continuously. And that's now maybe, Sean. When I spoke at the beginning of this month to David Bacher on the Korean report, in the global funds in the last year, best performing global fund by a country mile is the FANGS index of Signia. So it's one of those things, you put the money into that, it either shoots the lights out or loses half of what you have. The second best performing fund was the Mazi BCI Global Equity Feeder Fund, which did 38.9, edging BCI Ranmore Global Value Fund at 38% in the past year. This is a global value fund. You're not supposed to be achieving these kind of returns. A value fund is supposed to be way behind in this environment that we're looking at. We read so much about it. We get these guys doing their analysis on the S&P 500 index and take out the Magnificent Seven, which certainly aren't value companies, and then the rest of the index does so badly. Yet, Sean Peche's Ranmore gives us a 38% return. What gives? How do you manage this?
You know, Alec, look, thanks. That's very kind of you. And I did listen to David, and thank you to him for his kind words. Interestingly, if you look at the latest year, okay, the world index up 19%, value's only up 6.5%, growth's up 32%, quality's 27%. But if you look at 22 and 23 combined, the world index is only up 2%, growth's down 3%, value's up 0.65%. And we're up 26%. And I think the thing is, you know, we have the whole world to pick stocks from. And so I remember the late great Simon Marais. He used to say, all you need to do is find a few great ideas and avoid disasters. And I'm pleased to say that we've managed to, I better touch some wood here, avoid disasters. You know, we avoided the US banks. We avoided some of the metal and mining companies. I mean, we saw what happened with Anglo American. A lot of my value peers are in both of those spaces. We've avoided the brands, you know, some of those consumer brands. We see them coming under pressure. I've been writing about that for a while. And then, you know, we've had we had lots of little winners. And that is the key thing. You know, what you don't want is you don't want your performance all to be dependent on one thing. Because if we shot the lights out because we picked NVIDIA, well, and new investors come into our fund, the implied bet is that, you know, we've got to find the next NVIDIA. Otherwise, we can't repeat the performance. But if you get your performance from lots of ideas, we've got a process. We've got a very disciplined process. We run through, we screen stocks. You know, we don't have massive chunky positions. We say leave conviction to the convicts. You know, you just have lots of ideas coming through. And so what new investors are doing is they're buying a process. Our process is working. And I'll give you a perfect example. I mean, I woke up this morning to the news that Macy's has got a bid for $21. Okay, now in the depths of the October malaise, in fact, we've owned a little bit of Macy's for a while, but in October it got down to crazy prices. It was like 3.5 times earnings, and it's got Bloomingdale's, and you go, well, hang on, everyone's prepared to pay, you know, 20 times earnings for luxury products. Here's a department store that sells lots of luxury products, and it's on 3.5 times earnings. And its debt's well managed and pretty conservative relative to all the other department stores. We pick it up. So we're buying stock at $12 in October. And, you know, this morning it's got a bid at 21. So, you know, those kinds of things, when you start doing, we had Expedia last month that I wrote about our fact sheet. We were buying that in May. You know, it went up 40% last month. And so it's just these stocks coming through our process and capitalizing on them and avoiding disasters. So that's what we do. I mean, I don't know what next year is going to hold, but I know we're going to do the same thing.
But that's a very good point. So you are my proxy for Simon Marais, which is great. I don't think you could get a better proxy if you like. Yeah, and I'm sure you're not going to say you the
Well,
next
and
Simon
Andrew.
Marais. And Andrew as well.
Let's not forget
Tell us
Andrew.
about,
Andrew's my Charlie Munger.
tell us about Andrew.
Andrew's a top guy. And I've had the pleasure of knowing Andrew Lapping. Okay. And I've known Andrew's for over 20 years when I was at Orbis and he was at Allan Gray. And, he was chief investment officer there. He's had money in our fund for many years. And when he retired and left South Africa, we speak regularly. We used to speak regularly. We speak even more regularly now. Obviously, we see him, every day at 2:00 we have our meeting. And one day I said to Andrew, look, we speak all the time. You taking it easy or whatever, but we speak all the time. Why don't you join us? And so, we kicked the ball around and he did. And he could have gone anywhere. He's an absolute superstar and it's a pleasure working with him. He's a wonderful man and a brilliant investor. And so I think the two of us work, and we've got our team of analysts, but we have a great dynamic and it's working really well, as you can see. I did say to him, look, this is a free option for you because I'm the portfolio manager. So I said, the free option for you is that if it goes well, everyone's going to say it's because of you, Andrew. And if it goes badly, you can just say Sean's the portfolio manager.
but I loved what you said a bit earlier. The truth is
probably somewhere in the middle.
I love what you said a bit earlier because so often we hear the people saying, well, they have a conviction in US banks. US banks are cheap, or as you said, resources shares. If you're a value investor, you've just got to buy them, supposedly. But as you say, no, it doesn't mean that because a sector seems very cheap, that it isn't going to stay cheap. And in fact, everyone talks about bottom up or finding the companies that are great value, but not everybody does that. Many people would rather go into an exchange traded fund or not do the work. And clearly you're doing the work.
We're doing the work, Alec. You can get Google, Yahoo Finance, download a list of stocks with low PE ratios and buy those. That is not the answer, because many of those companies are cheap for a reason. Think about property. If you've got a property next to, it might be cheap, yeah, but it must be next to the railway line. It might be next to the highway. It's going to stay cheap. And so we want to avoid those. And a classic case is British American Tobacco. I think British American Tobacco is a massive value trap. And this is not going to make me any more popular with some of my South African peers, but the stock's down 24% of the last year. The price is down, over the last couple of years, 13% and you've had a little bit of, some dividends. The market's up 64% over that period. I think they've got 38 billion of net debt. They get 9 billion a year of cash flow, of which they pay 5 to shareholders as dividends, but their debt repayment is going to be 3 billion. So, and you just look at this and you go, this is a company. we don't like to buy companies that harm their clients. Essentially, that's what British American Tobacco does. And in 5 years' time, they're going to have arguably fewer clients or fewer customers because many of them are no longer going to be here, and those that are here are probably going to have switched over to vape. So you've got this 38 billion sort of drag on the business with the debt because they've got to repay the debt, and how easy is it going to be to refinance that debt? And this cash flow that's it's possibly shrinking. And if you look at it and you go, well, what's their business model been in recent years? It's been increased prices all the time. But now it's got to the point where it's a tough economy. It's hard to pass on increased prices. So volume is accelerating on the downside. It's falling at an accelerating rate, and there's an alternative. So eventually you get to that price point, you go, you know what, if you like smoking, well, maybe I should try vaping. It's 20% of the cost. So I think it's a value trap. And so you've got to be careful. You can't just, and that is why active management has a place, because passive, you just buy the list of stocks that have got low PE ratios. But, that, as you've seen with British American Tobacco and companies like Anglo American, it doesn't work like that. And so there is a place for active.
And we did certainly see that with British American Tobacco in this past couple of weeks, with a drop of nearly 10% after they wrote yet more off the value of the brands, Lucky Strike and Camel, etc. Those brands that they own. Yeah, it's an interesting point, that one, because a lot of people who are value managers almost feel like they've got to have BAT in their portfolios because everybody else does.
Yeah, that's right. And that just coming back to that 10%, people say, well, look at the dividend yields, 10%. Well, you lost that on Thursday or Friday or whenever it was. So in one day, you lost your whole year's dividend yield. So that doesn't help much. But I can go by ABN AMRO. Their earnings are not falling. I can get a 10% dividend yield there. So why do I want to go and, risk it on British American tobacco? And I think the other thing is, the pool of investors for these tobacco companies is getting smaller every year. People don't really want to own those things. So how's it going to get a re-rating? They're going to have to buy back the stock, but then they don't have the surplus cash because they're already spending it all with shareholders or debt repayments. So, so it's going to be interesting. It's tricky, but you've got to avoid the disasters. And things are not improving for that business.
Lots of common sense, but it's not so common when it comes to investing, the sense. But you've done a big deal. Let's talk about that one. At the BNC 6 in March next year, you're going to be helping people here understand more about the global investment universe, as you have at the last couple of conferences. Also on the stage will be Piet Viljoen. The two of you clearly have known each other for a long time, and now you have done a deal together. Just unpack the whole thing for us and how it came about.
Yeah, thanks, Alex. So actually, Piet and I'm trying to think how many years ago, probably only known each other for, 6-7 years. In the depths of the value, winter, Piet got hold of me one year and said, look, I'm coming over to the UK. I'm cycling over there. Can I ride out to the office and have a coffee? I said, Piet, do you know we're out of London? So it's a bit of a ride. But anyway, we thought we were going to form a value supporters group, to try and emotionally support each other through the depths of the value, winter, should I say. So, and from time to time over the years, we've kicked the ideas around as to how we could do something together. The problem is as soon as so we looked at, do we want to merge the funds? But that was a capital gains event for many clients where we manage the fund, but that increases the admin complexities. And we firmly, we don't manage segregated accounts here. Okay, so segregated accounts, we've got a fund and then you manage a pension fund amount on the side. They don't want to come into your fund. We are only interested in investors coming into our fund. And the reason for that, Alec, is that it then lowers the fees for everybody else. Because as I've mentioned in the past, you have fixed cost element, which is directors and auditors and legal and money laundering risk officers and those guys. And when you're a small fund, those are quite a burden on your total expense ratio. And so last year, when I was talking about the balanced funds and the performance fees and all the rest, our fund was small. And so our fees were high because of that fixed component. But our fund has grown since then, and that burden has come down a lot. And so our fees are much lower now. And so then, and I've also, just to some of the other people within Merchant West, I've known Paul Stewart. I met Paul. We worked together at Old Mutual at the start of my career, and Brian Pyle at the start of my career in Old Mutual. So you've got relationships that go back a long way, and these are good guys. And we have a meeting of minds. And so Paul got hold of me and said, look, what about if we convert our Guernsey fund into a feeder fund? And then that feeds into your fund. I thought, well, that's a brilliant idea because that then gives us more scale. So it's a win-win for us. And it's also a win-win for them because, $27 million, you've got that high fee component because of those other costs. And so if we merge the two, that can reduce that. And everybody's a winner. And then what they're going to do for us, as well as part of that deal, is market us to institutions in South Africa, to the asset consultants and the DFMs, etc. We don't have an office on the ground with sales and marketing people over there. It's certainly UK is a big focus for us, and we've made some huge strides over the last year over here. And so it's a win-win deal. But it's also importantly, it's not, there's no shareholding change, there's no equity deal, because that complicates things. All of a sudden I've got other people telling me what they want to do. They're sitting on my board trying to direct us. It's just I'm not interested in that. We just want to stay focused on performance. We do what we do, you do what you do, and we put the two together, and we find a win-win deal. And so that's what we've done. And
So
it's very exciting. So that's
really
the second leg. Yeah.
Mhm.
And then the third leg is
Basic stuff on that.
possibly
Let's
new
just
products.
understand how that
Basic
works.
stuff.
If you are invested in Piet's global value fund, which is in US dollars, presumably, that is no longer, Piet's no longer going to manage that. Sean's going to manage that in real basic terms.
Yeah, like me and the team, yeah.
Okay. And then,
that's right.
But you'd still put your money into the Merchant West Global Value Fund. It's just that money will no longer be allocated to shares that Piet will pick. It'll go, as you say, as a feeder. That'll go straight into the Ranmore Fund. Is that right?
That's right. That's quite right.
The one that did 38% in the past year.
Yeah, that's the one. So it's all, we've got all the money in one pot, nice and simple.
And what happens if it doesn't do, if it does 3% next year? Will it swap? Will they take that money and give it to another fund?
It's a bit like you're in relationships because you want to be in relationships. If the relationship doesn't work, and investors are unhappy, this is what we're going to do. This is how we work. We're same philosophy, same process, or whatever. And so if it doesn't work for them down the line, well, they can switch. But I don't see that that's a likelihood. But I'm not, we think this is a good solution for everybody.
But I'm still trying to understand why. Is it because you trust each other? Is it because particularly for you and Piet, because people have put money in there because they believe in Piet? Is it because it's easy enough for Piet to say, hey, Sean's just like me?
I think it's a benefit for everybody. And it's a benefit for the clients because they're getting exposure to a team. We've got 8 of us now focused purely offshore. And so that just helps Merchant West focus on the local market. We focused offshore, and that's happening. So you've got a focus team offshore at a lower cost solution. It's a win-win for everybody. So it's extremely positive. And I think it'll be, it's not like Piet's giving, we've got a meeting of minds. We speak regularly. We share the same investment philosophy. So there's no change to that. It's not like we're doing something completely different to what, Piet has done. But it's,
that makes sense.
Yeah.
That
so
makes a lot of sense. What you've just said now, because they would have invested in that fund because of a belief in the process that would be followed by Piet Viljoen, who also did come from Allan Gray many years ago as well. It seems like the Allan Gray guys have got a bit of a culture, maybe a bit of a cult that you've followed and you rinse and repeat. But it's the way you explained the process in the beginning and the way that your performance is reflecting it is not going to be a very difficult thing to sell. But I know being Ranmore, being based outside of South Africa, you're away from South Africa. It can't be that easy in getting yourself known amongst potential investors in this country by aligning or partnering in this way with Merchant West. Is that going to open up new doors?
I think so. I think it will definitely open up new doors. I think a lot of the, one of the concerns which has kept a lot of people away from us is that, they don't have a big fund. Are they going to be around? Are they going to survive, etc.? I mean, if we've survived the depths of the value winter, trust me, we're going to definitely survive. But this gives us more scale. We don't have to pay for marketing. We don't have to pay for feet on the ground in South Africa. So it gives us more scale, puts us on more radar screens. We've got people out there telling our story to those who don't know. And hopefully it opens up a new channel because there's quite a lot of inertia in South Africa in terms of, the funds. And you've seen that with some of the big funds just stay big and people are not moving to the boutiques. I think they're moving a little bit, and David Bach in the Corriere report highlights that some of the money is flowing to the boutiques, but not masses. So there's a huge opportunity for us. There really is. And so we're really excited about it.
And what more can you do? Are you thinking about maybe doing a joint fund? I'd quite like to invest in a Piet/Sean fund, one South African, one international.
Alec, I think Paul and I have had discussions, and Pete, and it's early days, so let's see. But one of the ideas could be a global value balanced fund. Okay, so balanced funds. If you look at the largest funds in South Africa, they're balanced funds, and look at the fee structures; they're expensive. And it surprises me that more people don't create their own balanced funds, because what is a balanced fund? It's got equity, local equity, offshore equity, and fixed income. But fixed income is really cheap. So if you go and take those components and you say, well, I'll create my own balanced fund, I'll buy local fixed income at and offshore fixed income at really low rates, and then I'll have some offshore equity and some local equity. You can get it much cheaper than if you pay for it via a balanced fund.
What's holding you back?
Sales.
What's holding you back on that? Because the way you've explained it now, I mean, it's an expensive product at the moment. You've got two trusted names from the investment side. I mean, you can't. Many people in the BizNews tribe will say, "Gee, if I could get Sean working for me offshore and Piet working for me in South Africa, add a little bit of fixed income, that'll be an ideal, and I can get it cheaper than what's around now. It'll be an ideal opportunity." So what's holding you guys back?
Well, exactly, Alec. That's exactly what we got to do. And we're not going to charge performance fees, and we're going to be a low-cost solution. And, Merchant West do the local equity, local fixed income. We do the offshore equity. And in fact, if you look around the world, fixed income, a lot of people, we had some clients who redeemed from our fund to take it back to South Africa because fixed income was so attractive. So emerging market fixed income is often quite attractive, and has certainly beaten offshore fixed income in recent years. So that's where the opportunity is. So it could be really exciting. Shake things up a little bit.
Sean Peche from Ranmore Fund Management, and I'm Alec Hogg from BizNews.com.